Hello everybody, and thank you for watching the Algo Maniac. In today's episode, we're going to talk about a basic fundamental concept, which is the law of supply and demand. And this is how the market and any market works. This is how the price is decided between buyers and sellers. And if you don't understand this, you're going to have a hard time moving forward fast enough. If you understand this concept clearly from the beginning, you will have no problem going on from the futures market, the stock market, the options market. They all operate in the same way. All markets respect the law of supply and demand. So the general basic idea, which all of you probably already know, is that if there is a certain item that is being put for sale, if there's a lot of that item on hand, there will be more sellers than buyers. If there's more sellers than buyers, sellers are likely to reduce their price so they can entice buyers to buy the product they're trying to sell. In return, when buyers see that there's a lot of sellers, they know that they're buying something that people are wanting to get rid of. So they lower their buy price, and sellers will in turn lower their sell price to chase after them until the price reaches a point where everybody agrees that that's the appropriate price for the item. The inverse of this situation is when you have less items to be sold and more people who want to buy that item. The sellers then know that they're selling something that is valuable, and they will tend to raise their price and let buyers chase after them. And buyers also know that there's not a lot left of that product they all want. So they'll have to raise their price in order to get to the point where sellers would allow them to buy it. This change in dynamic between sellers and buyers, sellers always trying to get more money and buyers always trying to buy something cheaper, causes the market to decide what is the current appropriate price for any particular stock or future or options or any other thing that we trade on the market. If you understand that concept, you can use it to your advantage in your day-to-day trading. For example, if you see that there's a lot of people trying to sell a certain item and you're trying to buy that stock, you don't have to chase after them. You can lower your price and let them chase after you. This way you get to buy it cheaper. If you're a seller and you're finding that there's a lot of buyers on the buying side and there's not so many sellers of your stock, you can raise your price gradually and you'll find that buyers will tend to chase after you. These changes happen in milliseconds. These agreements between buyers and sellers, who wants to buy, who wants to sell, happen in milliseconds, and we'll get to see that in practice on the stock market. Well, before I go into my trading software, I wanted you to see this here right on this sheet without all the flashing colors. Right here, this is what we call depth of market. This is a tool that most trading platforms have that would show you how many buyers and sellers are there at different price levels of for the stock that you're looking at, or for the futures contract that you're looking at, or the options, etc. So if you look at this scenario here, this is an imaginary company called Acme, and the current price is right here. It is now, the stock price is $100 per share. Typically the size in the depth of market is shown in lots of 100. So 20 is really 2,000, 24 is 2,400, and so on. So what you can see here is that there's 2,000 shares that are being offered for sale at $100.01. At the same time, there's 6,400 shares people are asking to buy at $99.99. The highest bid price is called the bid price. The lowest ask price is called the ask price. Typically, if you go on Yahoo Finance or Google Finance and look up any stock while the market is open, the data you will get will be just these three numbers here: bid, last, and ask. Ask is the lowest value for shares that are being offered for selling. Bid is the highest value that buyers are willing to pay. This is what we call level 1 data. In your trading platform, if you have just level 1 data, you will see this portion here. This tells you that the lowest offered shares to be sold are 2,000, and they're offered at $100.01. And it also tells you that the number of shares that people are willing to buy immediately now are 6,400, and they are willing to pay $99.99 per share. Now, if you have some of these shares and you wanted to sell them, you have the option to place your ask at a certain price level, or you can say sell it to the highest bidder, at which point it will sell to one of these people here. Now keep in mind, this number, just because it is in one unit here, doesn't mean it's only one buyer. This could be many buyers. The sum of the number of shares they want to buy at this price is 6,400. Similarly, 2,000 shares that are offered for sale at $100.01 are not just offered by one person. Now they could be, but it is not necessarily the case. There could be two people, each of them selling 1,000 shares. There could be one person selling 100 shares and the other selling 1,900 shares, and any combinations in between. Now, if you wanted to sell your shares, you could sell it to one of these people, or you could add it on to these people, or you can decide to sell it for $100 and make your own ask price here. So let's say you have 500 shares that you want to sell. You could, if you were to sell it at this price, this number will end up being 25. If you were to sell it slightly lower, this number will be 5, and the ask price will end up moving here. At which point, some of these guys may be enticed to take your 500 shares since they are now cheaper than the amount that they saw before. If one of these guys decides to raise his buy price to meet your offer, what happens is that he's gonna change his order, and momentarily the bid price will become $100, at which point the exchange, which is the New York Stock Exchange or the London Exchange or whatever exchange that you are trading on, will end up matching buyers with sellers and then taking both of your orders out of the market. What's going to happen then is the last price is not going to change because it also happened at 100. The ask price is going to move immediately back to the lowest seller, and the bid price is going to move immediately back to the highest buyer, and we'll go back to the same situation. Although if this guy was one of these 6,400, the 6,400 now will turn into 5,900 because 500 shares that this person held at this level has been already bought, and so he is no longer in the pool. Basically, he is no longer in the market looking to buy. If you were to sell your 500 shares directly to one of these guys, the same thing will happen. You will immediately move the ask price to this price, which will immediately match the bid price. And what happens then is his order and your orders are going to match, and the last price is going to immediately change to $99.99, and this will be like that. Now we understand how this happens. This happens very, very fast, hundreds of thousands of times throughout the day. And now I will show you how this looks in a real open market. Let's go and see that now. This is Ninja Trader, and this is looking at a simulation account, so there's no real money being used here, but this is still a live market with live data. What we're looking at is the S&P E-mini futures market, and right now it's 6 p.m. Pacific. The market is open. We can see that every bar is 5 minutes. I'm gonna change this chart to 1 minute chart so you can see every bar here represents a minute. What you see here is the tape. Every line here is an actual exchange or sale that took place. And so you can see 2 contracts were sold at 32.20, 2 contracts were sold at 32.20, and so on. If it's green, that means one of the buyers decided to take the price of the ask. If it's red, it means one of the sellers decided to sell at the bid price. Here is a depth of market tool. They call it Super DOM, and these are the number of contracts that buyers are buying at these different price levels, and these are the number of contracts that sellers are selling at these different price levels, and the transaction only happen at the point of meeting down here. And the difference between this price and this price is called the spread, and usually the transactions happen between the spread. This highlighted in yellow here is the last transaction, is the price of the last transaction, and the number in parentheses is the number of contracts that took place within that transaction. So you can see right here, 32.19 is the last price that something was sold or bought at. If I want to demonstrate how market is likely to move, we're seeing that there is a trend of the price going down, but there is a mini trend of the price going up momentarily, and it might turn back down. You can tell this if you are familiar with this market. You'll see that the overall numbers here, even though they're not the lowest sellers or highest buyers, but you can see that the numbers here are slightly less than the numbers here. What that means is that there is selling pressure, and then there's less buyers than sellers. Although at the very so you can see how things change very frequently and very quickly, and we're not even during the daytime hours, so things can move pretty fast. If I were to demonstrate and take advantage of this, I would at this point sell to one of these buyers. I'm selling 3 contracts at 32.19.00. Here we go. That filled right away. Now the market has moved against me. If I want to exit now, I'm going to have to take a loss of 1/4 of a point for 3 contracts. That in this market is about $37.50. So now, if I want to exit this position, I want to cover or buy back the shares I sold. So I'm looking to make some money. I'm waiting for it to go in my favor. Otherwise, I will get rid of it. So we'll wait a second. Here we go. Now it has gone down as I have expected. 32.18.75 is a price that I could take, and so I'm gonna buy 3 at that price and hope to make that 1/4 point. Now I have filled, and if we look at the executions here, you'll see that I have sold 3 at 32.19.25 and bought them back at 32.18.75. That's 1/2 point per contract. That's $25 per contract, and I've done that for 3, so I've just made $75. This is obviously a simulation, and I didn't make any money doing this, but this is real live data. If I were to actually have used my real account, I would have made that money. So now we've seen how you can take advantage of volume or size on the buyer or the seller side, so you can make money with small moves like that. As you've just seen, the changes in price between buyers and sellers happen very fast and happen very frequently, and it is what causes the market price to fluctuate throughout the day and over a period of days and over a period of weeks and so on. It is always about the law of supply and demand. When people want something, they are willing to pay more for it, and where people don't want something, they are not willing to pay more for it, and sellers are likely to lower their price to get rid of the stock that they are holding. I hope this was clear for you, and I hope you've understand and learned something new, and I look forward to having you in another video. Please let me know in the comments what you'd like me to make videos about, and if there's anything that you'd like me to talk about and explain, I'm happy to. Once again, thank you, and please like, share, and subscribe.